Good morning, good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. On the call, on the screen today, we've got Mike McGlone joining us from Miami. He's become a regular voice here on this call, been a member of the team for years. So glad we've got him to be a regular on this conversation. Hopefully, we also are going to have our colleagues Patricio Alvarez and Vince Piazza join. For some reason, we always seem to have a little bit of technical snafus here at the beginning, so hopefully they'll be on soon. But Mike, let's kick off the conversation with just what's going on in commodity land. And one of the things that I am curious about is, kind of how interest rate policy, Fed policy, these kinds of things play into what's going on in the commodity space. I think inflation came in a little bit hotter than expected this morning. And I'm curious as to how you think general concerns about inflation and kind of what's happening with interest rates feeds into where not just energy commodities, but commodities could go in general when you look out over the next 12 months. So Mike, first to you.
That's a great start. This inflation, sticky inflation lately, you can say it's a bit of an uptick, will be transitory. I have to use that to be somewhat provocative. I love that term you use to point out the facts of what's really happening in commodities. Virtually all commodities are still under the affliction from the high price cure. Crude oil, corn, copper, wheat are well down from those peaks from 2022. And the only major commodity going up is gold. And I expect that to continue. And I don't think it's coincidence that the first week of the year, crude oil made a new high. Of the quarter made a new high for the year. And the S&P 500 did and started rolling over. Now they're all starting to roll over. So to me, we've had short bounces in bear markets in crude and copper. There was only one market I think has really reached that low price cure. That's the number one is natural gas. It got well below the cost of production. I think everything's rolling over in the back of beta. Beta is overwhelming right now. By saying beta is the fact that gold is up almost 5% more than the S&P 500 total return this year is a bad sign. You don't want the rock to beat stocks. It's just not a good sign. And it's significant that gold is way outperforming the S&P 500 total return since the end of 2021. That's significant because what happened in 2022? We had the unlimited friendship. We had the Russia's invasion of Ukraine, and then the sharpest global tightening in history. So to me, everything's tilting over to that great reset I started talking about 2 years ago, going dormant and kicking in. Here's one good indicator. If you look at the average bond yields just on the WB on Bloomberg, the WB function, you have average bond yields in Europe are 2 to 3 handles, 10-year note yields. In China, it's 2 handle. South Korea, it's a 3 handle. Canada, it's a 3 handle. We got 4.5% U.S. So the rest of the world yields and the inverted yield curve are showing severe deflationary recessionary risks. And I think the inordinate burden of U.S. stock market staying up is starting to kick down. So this is why I'm putting in, I think the key test will be this year for all markets will be when we finally get that first backup in the S&P 500, which might be starting now. The excesses I've seen in terms of price and valuations are some of the worst I've ever seen. I remember seeing them right before 2000 and right before 2008. And I just use one simple metric versus a 100-week moving average. The stock market's expensive. So to me, everything's tilting down for a normal reversion. And then a bottom line I like to finish with is we have that inordinate burden of U.S. stock market going up, U.S. dragging the rest of the world out of this malaise. If you don't agree with me, look at bond yields. They're showing there's a problem. And that's the lowest volatility in U.S. The VIX index at 25, the 52-week moving average of the VIX in the U.S. minus the T-bill rate is the lowest since that foundation is set right before the great financial crisis. So mean reversion is the key thing I'm worried about. And I've been early. I've been wrong. I think I put fill or kill in this year. I think the next big significant trend for WTI is head towards 50, maybe lower. I think copper's probably peaked. I think it's more likely to go to 3 than 5. It's 4 and change right now per pound. I think gold's going to head to 3,000. I just a question. I don't know when it's going to get there, but that's what's happening. And we do have this tilt towards, there's a problem now, is the high price cure that afflicted commodities is now trickling over to the stock market. One thing we have to admit is that we had big upticks in the stock market in March, and crude oil big upticks, and at the same time upticks in CPI. There's a connection.
Very interesting, Mike. I want to share a couple of charts. I know we don't normally do this, that maybe will help everyone thinking about this topic, and we're happy to show you how to pull up any of these if you'd like. So real quick, just on the screen, I'm showing quickly the just the Bloomberg BCom total return commodity index, and a lot of what you just described has unfolded over the last couple of years. We really saw the peak in mid 2022, and it's been coming down ever since. And maybe one of the reasons that that peak coincided with just an insane run up in the gas price over in Europe. I think a lot of that relates to geopolitical factors. But one of the things that still tickles me is that, Europe's at, $8 and change in terms of dollar per MMBTU versus sub $2 Henry Hub. So with that, I want to bring Patricio Alvarez into the discussion. He's joining us from his usual perch over in Madrid. And Patricio, I know we kind of go back and forth, but it does look like the gas crisis in Europe has almost, maybe it's over. But you tell me, are we in the clear now? And what does the market actually look like as you look over the next 12, 18 months?
Yeah, I think it's safe to say that the energy crisis has taken a backseat, or it's very close to over. It looks like it's very much demand drivers taking hold over prices. I think our view is that gas prices have very little risk of moving from that 20 to 35 euro per megawatt range. They are currently at 27 at the moment, so that is roughly $8 per MBTU. Which is a lot cheaper than it was at its records in 2022, which were almost close to $80 per MBTU. But that is still nearly 4 or 5 times what gas prices are in the U.S. So that just again hits on that the industrialization trend that we've been talking about lately. And given that there's no structural drivers for industrial demand to pick up significantly, given that most Western economies are sort of on a stagnation aside from the U.S. We don't see that moving very much. We do flag that there are some supply risks in the horizon. We do expect Russian gas flows to potentially cease beyond 2024, which is when the contract for them to be routed through Ukraine ends, and we expect those not to be renewed. And the other risk is that Russian LNG, which still accounts for a fair share, roughly 5 to 6% of European supply, we expect those to be sanctioned over the next 12 to 18 months as well. So on the supply side, there will be a bit more tightness, but again, it's very weak demand that is likely to keep gas prices in that 20 to 30 euro a megawatt range.
All right. Thank you very much, Patricio. Mike, let's come back over to you. I will just flag that the other day you had a note out called Party Like It's 1999, Stocks versus Commodities and Reversion to Risk. Hats off. Very provocative title for your note. And I think you were hinting at it in some of your opening comments. But what do you make of this idea? I love the exploration you're doing on kind of the bull market in equities versus what's going on in commodities, and how do you slice those two worlds? And should there even really be any kind of relationship between equity world and commodity world?
That relationship between commodities and equities, particularly crude oil equities, was really solidified after the great financial crisis. And virtually every single plunge we've had in crude oil has coincided with S&P 500 since then. When S&P 500 leads, it depends on drag period, certainly 2018, 2019, and then for COVID. But I appreciate you mentioning that. So one key thing to always remember about when we measure for the outlook for commodities, use a spot index, BCOM-SP. BCOM-SP is just a spot prices. The total return is for investors, and it can be somewhat deceptive in the outlook for what commodities mean. And one thing I wanted to point out recently is sometimes there's periods when supply and demand matter, and there's other times there's period when the macro is overwhelming and the correlations are overwhelming. So right now, to me, we're in a period where the macro is overwhelming and the inordinate burden of U.S. stock market to stay up is all that matters for all risk assets. And gold sniffing that out, I think. Despite significant outflows in ETFs, gold's still marching higher. But the key thing I want to point out, as you mentioned with that, you just look at key things. First, the Bloomberg Spot Index versus the S&P 500. The S&P 500 is the highest since 2000 versus this Bloomberg Spot Index, so like a quarter century. Then you take relative value. Just take the S&P 500 versus 100-week moving average. It just recently dragged 100-week moving average, touched about 25%. That's a pretty high bar. I mean, I just go back 20 years on that. It doesn't stay above that level long. It always reverts. At the same time, the Bloomberg Commodity Index was about 12, 13% below that same level. Last time we had that crocodile jaw disparity was 1999. So the key thing I'm pointing out, though, is I'm not saying commodities are relatively cheap, but to me, the bottom line is this: history will prove that means the stock market's relatively expensive. And that's the key thing I point out is I have to point out, I look at markets when I used to be at a hedge fund, and I think of all the clients and people who use Bloomberg terminals are running money. Bottom line, remember, is crude oil is not driven by OPEC or fundamentals. It's driven by leveraged futures traders. I used to be one of them. And what triggers them to make buy and sell decisions? And to me, this is the key thing right now, is the risk of beta having a little bit of a backup. And I have to point out what I think is going to matter most. When you do your value at risk models, what's the risk for everything I hold? If you have a long crude oil position right now, first of all, managed money net position hedge funds are about the longest they've been since last year's peak around 95. So you're a bit overweight. Your value risk model will probably suggest that if we have a normal correction in the stock market, which is way overdue, 10% is normal, that's the biggest risk to all assets right now. And that's what I see as the overwhelming force. And that's what I like to point out is we did somewhat peak the stock market at the same time crude oil did around about a week ago. And now we're seeing the problem is that high price cure is kicking into equities. Every time equities go up, inflation stays sticky, the Fed can't ease, boom, you see that lose-lose. So to me, that's the whole tilt. And like I said, like Patricio mentioned, that we have pretty stagnant economies in Europe. I mean, Germany's in a recession, Finland's in a recession, you name it. And the bond yields show there's a recession. Just look at the German 10-year note yield is in a 2 handle. And U.S. is in a 4, and China's in a 2. Those are bond markets telling you is a problem. So I'm just waiting for the next shoe to drop. And to me, gold's figured it out. I think copper has got a little expensive, so I'm just hoping they can stay rich, and I'm fearful that the normality will kick in. That's the number one force in markets is mean reversion. And like I pointed out, yields are low in the rest of the world, stock market's high, and volatility is really low. Just a little bit of reversion is what I think gets crude oil to 50. And just imagine if it goes to 100, that makes it worse on if we have geopolitical risks, that's what it's going to take for WTI to get to 100. And then I'll end with this. One thing I like to publish, I've been doing periodically when I hear things of people getting really bullish crude oil, I'm like, it's the worst performing major commodity. I always like to point that out. It's the compared versus the Bloomberg Commodity Index versus copper versus soybeans. The most autocorrelated, worst performing commodity is crude oil over time, particularly in the last 10, 20 years. Has that changed? Is a key question I'd like to ask. And I just like to point, it's just the most significant. And so I'm watching a lot lately is a gold crude ratio. And I think the gold is going to continue to appreciate versus crude.
I love your story, Mike. We're going to have you back on to debate our colleague, Salih Ilbaz, who's based in Dubai. And he's got a note out this morning that talks about the risk of $100 oil. He and our colleague David Zhang on the data science team have built a fair value model, basically a regression model that looks at various factors, including geopolitics, that could help to drive oil price. And anyhow, they've got a note that makes the opposite call. So battle of ideas, and we're going to keep hitting on these topics. But I actually want to swing back around to Patricio, Mike, because I was thinking about your comments about recessionary factors in Europe. And there was a really provocative piece out from our colleagues at Bloomberg News yesterday. It wasn't about European recession, but it was about European power prices and how nuclear fits in that context. And I'm going to show a quick chart again because I was quite intrigued by this. Well, actually, I won't show the chart, but we'll share the article in the notes afterwards. But basically, day ahead European power prices in France, in Spain, other markets, they've been coming down, kind of like what's been happening in it with just the gas price that we did show earlier. And in fact, we've been seeing some zeros here lately. And Patricio, I really want to probe on this topic because I'm fascinated by it. What's going on with European wholesale power markets? I know the answer because I've thought a lot about wholesale power markets in my life, but are they working like folks think they should? What does it even mean to have a zero power price in the middle of the day or a low power price? Are renewables messing up the way the system works? What does it mean for nuclear? Do we need long-term contracts? Do we need to go back to regulation? I'm just curious about how you're processing the way these markets are working, particularly given this big decline in prices. So the signal is not telling you to do nuclear or anything or any sort of base load. So anyhow, I believe you saw the article, but tell us what you make of what's going on with the wholesale power markets in Europe right now.
Sure. So I think it's good to start with how demand works throughout the day. So demand for power tends to be lower during nighttime and higher during day hours. But there's been a strong recovery in power supply relative to, let's say, the crisis in 2022. It's a combination of higher hydro, so a lot of hydro reserves across the continent are at above the norm or near the norm. Also, nuclear power output has rebounded quite well in France versus the lows of 2022. So on top of that, you have a lot of incremental wind and solar capacity that has been installed, and also adequate, I would say, wind speeds. So it's sort of a combination of that little increase of supply during the day, and the lack of storage capacity. That means that all that excess power cannot be stored. And given that it exceeds demand and there's no way to store it, no place to store it, you need to start sort of paying companies to curtail, or let's say in the perfect world, you would pay them to curtail power. But that means that higher cost technologies or technologies with higher fixed cost, like nuclear, will be loss making when wholesale power prices hit zero or even turn negative during times of the day. And that is becoming it is an important issue, at least for some of the utilities I cover. Although these intraday declines they're only intraday, and they're kind of just blips on the radar. They're not sustained. They're not going to be month-long periods of negative prices. It does mean that you're running plants that you cannot shutter, either because you need to ensure stability of supply, because regulators won't let you, which means that you need to run those plants at making losses, which are not huge, but it is concerning. By and large, utilities have a large hedge, which is their supply bases, which means that they can manage the rest of their power assets to meet demand with their contracted customers. But overall, it is, let's say, problematic. At least it is a problem or a headwind for investments in renewable power. I think looking forward, just given that a lot of the contracts or the long-term contracts that you signed, that you're going to sign, are usually pegged to wholesale power markets. And also, I think it would decrease the appetite of large consumers to take on long-term contracts if they know that spot power prices are much lower. So it does cause a problem, and I think the problem is mainly that there's not enough storage capacity at the moment. The batteries cannot take on that excess capacity and redistribute it throughout the day.
Yeah, I mean, for folks who don't think about power markets very much. They are quite unique versus oil or corn, other commodities, because you have to basically produce and consume the power in real time, so that there's effectively no storage, so you get these wild swings. I am going to try to share this chart just real quick. It's on the screen now, and again, we'll include the link to look at this, but yeah, it's quite fascinating what's been happening with power prices in Europe. And I do think that policymakers are going to have to really think quite profoundly about this kind of topic. You basically, in some sense, Patricio, just made the argument for why regulators in California rolled out what they call NIM 3.0, Net Energy Metering Policy. And the regulators there basically observed this type of phenomena happening in their market. And they said, hey, solar is great, but there's too much of it in the middle of the day. So if you want to do solar, you can't just do solar. You need to do solar plus storage. And I think we're going to see a lot of regulators like really sort of wrestling with this topic and how it interplays with wholesale power markets. And also regulators are going to have to really ask themselves the big questions. You know, do you keep the nuclear plants around? Do you keep these big baseload sources? And that there's no right answer in my view per se, but I think it's going to be a provocative question over the next 10 years. With that in mind, we do have a question in the chat. And by the way, for anyone who's listening, feel free to drop questions in the chat. We will try to get to them as we kind of run through some of the things we want to highlight and discuss with you. Or certainly if you hear us talking about anything, ping us over IB or email, and we'll get back to you, because this is the point of these calls is to highlight some of the work we're doing, but also to give you an opportunity to ask questions. And so this one might be more appropriate to have someone from our industrials team come and join us on the call to talk about that. So I will follow up to see if we can do that. But in lieu of that, just here on the call today, question, Patricio, is there an issue with transformer demand? We've seen, I regularly see this idea crop up that transformers are a constraint on the system. And is it something that your companies are actively talking about? Are they worried about ability to get transformers or other equipment as they do all the sort of kind of boring stuff in the background to make sure that the grid's functioning, well performing? So any insight on where the transformer idea is at the moment?
So I think, well, without like you said, without going too much into the weeds, because I think it's more for the industrials team to give a more granular answer. I'd say that that doesn't seem to be a problem that is on the on between the key issues that the European utilities are looking at. European power utilities are still very much favoring investments in the grid. That's because of two reasons, mainly because higher interest rates have made renewable power generation or new assets on that front less profitable and less, let's say that, it's harder for them to achieve their hurdle rates there. And on the other hand, the second point is that capital discipline is also forcing European utilities to rein in their spending. And by and large, investing in European grids, that tends to be regulated. Those are guaranteed revenues where you get paid for the capacity you operate, and that also accounts for increased debt costs and for inflation as well. So from that front, let's say the tailwinds for investments in transmission and distribution grids are still there, but I think balance sheet capacity will also be a factor to play a role. And so far, I don't think there is a risk. There wouldn't be a risk of like transformer capacity being an issue, at least not in Europe, because by and large, we're talking about expansion rates that are not massive. I mean, you're talking about regulated asset bases growing at 7 to 8% a year, and most of these planned expansions are very back-ended. So you're talking about 4 to 5% over the next 2 or 3 years, and more of 7 or 8 towards 2030. So I wouldn't say that is a problem that is very imminent.
Drag.
Okay, thank you, Patricio. And just I note that there's another question in the chat on AI data centers. I would point you that just maybe 3-4 weeks ago we had a little bit of a discussion. I know Mike was on that call. I think you might have been on there too, Patricio. So go back and look at that. But I would flag that we are in the process of rolling out some more research on that topic. Both Patricio and I are working on some deep dives on that very question. So we know it's a hot topic of the moment, and we're going to hopefully have some good ways of thinking about it going forward. But I want to switch gears because we're almost at the end of our time, and I see that our colleague Vince Piazza has joined us. Great to see you, Vince. We were in Kansas City last week. Mike was there too. Sorry for anyone who missed that. Had a great discussion kind of on the intersection of ag and energy. But Vince, for you, I want to come to you and give you an opportunity. You've got a pretty interesting note out this morning looking at the earnings cycle for oil and gas companies in the U.S. And I think you basically make the argument that 1Q could have been a bottom for some of the financial metrics. So tell us about your note.
Yeah. Hey, thank you. Good morning, guys. Sorry for being late, but so aside from what I do on the energy team, I also help out the strategy folks on the energy sector. So I cover energy more broadly on the equity strat team, and I do a quarterly update. And so this is the first of 3 notes that is going to come out this week for a broader report. And yeah, so I think when we think about the earnings and the financial metrics for 2024, I think Q1 is most likely a bottom. Hey, look, you know what? Natural gas was sub $2 Henry Hub for a good chunk of the month of March and into April as well. So I think this is most likely a bottom. Sub $2 is unsustainable. We have operators curtailing output. We have operators pulling back the reins on CapEx. So I think things will tighten from here on in. Also keep in mind, I was looking today, Waha hub prices, which is Texas. Texas gas is negative. Those prices are negative. Those can't sustain themselves either. So I think what we're seeing here, and if we look drag the next couple of earning margins probably bottom for 2024, and things should improve from here. We do have earnings revisions, negative earnings revisions in Q1, but not as significant as we saw in Q4. The crude oil, I mean, we're testing close to $90 on Brent. It's roughly $4 or $5 below on WTI, but I think those levels can be sustained. I don't know if you got to be sustained, but we've had some work done on the OPEC side, and I think from all the feedback that we've gotten, it seems that those production cuts will likely remain in place. So, I think for right now, I think the worst is behind us, and barring any kind of recession here, I think the worst is probably behind the equities as well. So 2024 looks a little better. If we do get those sustained curtailments, we could see, and especially on the spending side too, if spending is curtailed as well, you could see better free cash flow. And better free cash flow means base dividend, supplemental payments, some buybacks as well. So hopefully we'll get out of this rut that the energy space is seeing. I think we talked about this during the conference, Rob. Energy is less than, right around 4% of the S&P 500, and it's been this way for a bit now. So, maybe we'll see a little bit of love here as we get past these issues on the balances with relatively robust production. We just needed demand to come in, and really for natural gas, the cyclical issue The longer term trend is actually fairly positive. Yeah, barring any kind of recession, I think we could have a better backdrop from here on in.
Bragg. Thanks, Vince. And, I do think about that chart periodically of the composition of the S&P 500 index. And, you got to go back, 15 years and it's, you're talking 12, 13% of the index versus the number you described today. Maybe this is a good place to end of kind of, is energy a sort of rounding error to the overall S&P 500 or the world market? Do you see that share staying lower, given your outlook on the fundamentals? And I'm going to come around to the others on sort of this idea as well. But Vince, we'll let you sort of opine on the relative importance of energy.
Well, I still think, and I know about this last week at the conference as well, that natural gas is a longer term share gainer within the global energy complex. And so I think in that regard, yes, I think that it will continue to gain share. It will continue to get mind share as well, just given the end markets that it will serve. Oil, you know what? Even if we electrify on-road vehicles, we'll still have demand for that hydrocarbon. So it is embedded into the fabric of the global economy. So, yeah, I think that, we've trolled the bottom, sub 2% during COVID, the COVID lows. We rebounded to 4. Do we get back to 12? I'm not sure we're going to find another commodity super cycle. But if there's better growth in India and if China rebounds, you could see that demand spike. But for the most part, I think that the last 3 or 4 years, we've been trolling the bottom on its composition within the broader S&P 5.
Bragg.
Okay, Mike McGlone, I know you've always sort of got your own view. I love that you march to your own drummer. How do you see this question?
Well, we must do that, in particular in Bloomberg Intelligence, because we have our individual views. So I do agree with Vince that natural gas is low, but as far as the view, I think the risk is that energy will become a greater part of the S&P 500 because tech will go down. And in normal reversion, the whole index should go down. If it follows just bond yields in China and Europe and the rest of the world and the significantly low volatility in markets follow trends that typically I don't think have ended. Crude oil is in a bear market. I think it's the upper end of the range. Copper, upper end of the range. Gold's the only significant bull market. And the fact that it's beating the S&P 500 by 5% this year, despite significant disdain for gold and ETFs, it's just the lessons of money management. You're supposed to be looking at the stuff that people hate. And there's been $8 billion of gold outflows this year in ETFs. And gold's still, right now, at about a record high. It's really the only market that's not really down today. And so that's why I see it. I think just upper end of the range for crude and copper, and that's what we make a good market, and we can express our individual views. The bottom line I point out is the world's bond yields are at a significant discount to the U.S. for a reason. They're tilted towards recession. And volatility in U.S. stock market and interest rates are, that disparity is about the same as it was right before the great financial crisis.
Fantastic. Okay, Patricio, we're going to come over to you for the last thought here. And we've been talking oil and gas, but let's pivot a little bit to utilities. And the question that always comes to my mind is, when you go to school and you're taught about stock markets or equities, you always sort of get this idea that utilities are grandmother stocks. They're supposed to be stable and all these kinds of things. I don't think that's aligned with the current reality. So I'm curious, where is the space that you're looking at? And is it a sort of increasing or decreasing share of the European indices?
Well, they're not so dissimilar to what to the granny stocks you're mentioning. They're still fairly stable stocks. They represent 8 to 10% of the broader stocks Europe index, and they've been stuck in that range for the past 5 years or so. Now thinking about what the earnings outlook is for the next 12 months or so, is that these companies are sort of in a tough spot because they have very, very hard comparisons. In 2022 and 2023, very elevated power prices meant that these companies could place on very high-priced hedges, and they won't be able to avoid a hedge or a revenue cliff in 2025 and 2026. So their earnings are going to normalize significantly over the next 12 months or so, which means that on the EPS side, you will get flat to declining growth. And on the other hand, well, if you want to say something positive, I would say is that they've been quite active in rationalizing their balance sheets. Leverage ratios are coming down, stabilizing almost below three times right now, 3 times EBITDA. So that means that there's no imminent dividend risk, and the dividend yield is at 5% more or less for the sector, which is not super attractive relative to this period of higher for longer rates. So yeah, overall, I'd say that this sector is kind of in a lull. It's kind of stuck in a tough spot for the moment. But no significant risks. They're utilities. I would say utilities in Europe are becoming boring again, which I guess is a good thing.
I love it, the idea of boring utilities. But obviously, all this is very important. For anyone who's still with us and listening, let me just make a quick advertisement. One of the things that you may not be aware of is that for the vast majority of companies that we cover, we have built interactive calculators for those companies. And we're on a campaign to try to sort of increase awareness. Maybe on some future calls, we'll go through some examples of how you can use them. But basically, they're for either companies or commodities. If you run MODL, you can see a deeper form of consensus. You can open a calculator that's dialed into consensus and then sort of say, hey, maybe I have a different view on realized oil prices. Maybe I have a different view on how many electrons or the generation mix or portfolio of a certain company going forward. So you can run your own scenario and develop a view on an individual company or commodity. So if you haven't checked out MODL and looked at some of our company calculators, or you haven't run BECO to look at some of our commodity calculators, I highly encourage you to do that. We're happy to chat about any of those with you at any time. And in some of our future discussions here, we'll make sure we highlight how you can use that tool that is part of the Bloomberg Professional Service. So with that, I think we're going to leave it today. We do these calls every Wednesday, so I hope you are able to join us again next week, and I hope you have a great rest of this week. Take care, everyone.